Hey, welcome back. So lately I've been thinking about reworking a very old series where I talk about my portfolio and recent changes, earnings, dividends, buys, sales and the things I learn, and I also got some interest from some of you. It's the first episode of the new series, so let me know if you have any feedback. Now, the entire portfolio is a bit complicated to show because I don't have it all in one place, but the public one on eToro is a good representation of what I have overall, so we can use that for convenience. You can see the positions on the screen, so feel free to pause if needed. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even two each month, check out the Patreon link below. All the cash, by the way, gets a roughly 3% interest paid monthly by eToro, which you can also join using the link below to support me, so it's at least around inflation. This has been among the best months in a while, although it kind of fell at the end. There is a ton of stuff to talk about and I can't even remember the last quarter with as many developments as this month, so let's get into it. To begin with the dividends plus interest on cash, they weren't that high, but I got about 0.22% thanks to Verizon, Nokia, AbbVie, Omega and of course Realty Income. I estimate the overall yield of the portfolio at something around 4% now, but that's not the main focus, it's mainly value oriented. I pretty much used that money to buy StoneCo for the first time, but not on eToro because I have people copying this portfolio and I want to get a better risk and reward level for them. It's the same I did with Coolco some months ago. Again, I have to be more mindful about this portfolio in particular because it's not only my money doing what I do, so I have a greater responsibility. Now, the buys were, as I mentioned, StoneCo, which I'll talk about in a video very soon, and Lyft, which I already analyzed like a week ago. Again, everything is very fresh, so check out the videos to get more in-depth details about both of them. I want this to be all about updates that I haven't really mentioned, and there is plenty of that. Now, let's begin with China being up, because there is a lot to talk about. If you look at the 4 Chinese stocks I analyzed in January, I talked about China's policy shift offering huge potential, and indeed, they are up even like 10, 20, 40 and even 70% from that level in a bit over a month. But the policy shift isn't everything that's behind it, and there is a lot of politics in the middle, especially now with Trump in office. Alibaba reported earnings slightly above the market's expectations and even some nice growth in cloud, where Alphabet had some issues. By issues, I mean it grew by 30%, but the market had some worries about the capacity that resulted in them planning some massive capex this year. They also announced some new AI models and even 50 billion worth of AI infrastructure investments over 3 years. I mentioned in the new Google stock analysis that pretty much all the major tech companies do that. Google, Microsoft, Amazon, Apple, Meta and more announced some huge investments in AI very recently. China also held a tech meeting where Jack Ma also attended, I guess in a political move to give the market confidence and show that, he's alive. All these things combined resulted in massive growth, especially for Alibaba and Tencent. Baidu also reported earnings, but they weren't as good, and from like 25% at the peak in February, it ended the month well below that. They had some issues in search, which is the core of the business, but delivered very good results in AI cloud, well above Alibaba. I think this one remains very cheap, and having so much cash, even above the market cap, basically makes this company a blank canvas. Sure, you have the actual business and investments, but also tens of billions of dollars on a 30 billion market cap. I think they are at a point where a potential buyer basically gets most of the money back in cash plus the actual business that's able to make more than 2 billion after interest. But again, it's China, so would anyone be allowed to buy them? We can't know, but at the same time, is China okay with Microsoft competing with them in search when Google is banned? China already switched from Windows and other Microsoft products in government PCs long ago, so who knows. A quick update on B2 Gold as well, they also went up on earnings thanks to projects advancing as planned. I think this is probably the best buy in the gold mining sector for me right now, and they are developing around the market's concern regarding the dependency on Mali. The new mine should become operational later this year and it should increase the company's production significantly, so if we keep seeing gold at such prices, this can make a ton of money. And if the stock doesn't recover, this can either become a massive dividend payer or someone could buy them. Among the healthiest balance sheets in the market, good and low cost production, reserves, just opening a new mine now and well below the industry's prices, so plenty of potentially interesting things for a buyer. Now, in mid to late February, we saw Celsius going up 12% before the earnings date and then up 30% on the day of the release. I called Celsius a great acquisition target before, but it seems like they are the ones doing the buying now, acquiring Alani Nu for 1.8 billion worth of stock and money. I think this is a very good buy, and growing two brands like this can really turn it into a very big player in the global market with potential to expand into more. The quarter, by the way, was above expectations with a slight revenue decline but significant increases internationally. For a reference, Celsius alone, the number 3 player in the market, contributed once again about 30% to the overall growth of the energy drink segment in the US. That actually says a lot about the market today for a not even 12% market share player that only grew the revenue by 1%. To some degree, that also explains the market's reaction that we saw in the stock before. I think Alani Nu fits their portfolio well, focusing on younger women and health/wellness, being actually the number 4 player in the US with about a third of the market share that Celsius has. And Alani, by the way, represented another 20% of the category growth, so the combined company theoretically represented about half of the US energy drink category growth in 2024. How I see this is they basically captured a very high growth competitor before it potentially exploded, which is what a good management team would have done to them ages ago. They expect minimal cannibalization, which is kind of questionable, but now they have two brands that they can develop globally. They also said they see 50 million in synergies and expect it to be beneficial for the EPS from the start, with a significant cash flow generation potential. This is also an advantage for negotiation with distributors and stuff, and they also have some supplements and nutrition, so keep that in mind. So overall, really fantastic news from this company, and I think it's still cheap for me even after such a spike. Then Adecoagro's largest shareholder announced that they want to increase the stake to 51% from around 20% today. By the way, if you think that Tether sounds familiar, it's because that's actually the Tether behind USDT. And I guess it makes sense to have a stablecoin interested in one of the best agriculture companies on the planet. I don't know what they plan, but if they integrate Adecoagro and maybe tie the real commodities to a cryptocurrency or something, this can see much more attention from the market. We've seen other commodities tied to crypto before for transparency and sustainability, and to be fair, crypto, as much as I don't like it as an investment, could be part of the future of logistics in the industry. Anyway, the stock jumped like 10% on the day of the announcement, and the company later initiated talks to see the most efficient way to do it. They wanted to pay a premium of about 20% from the level before the announcement, by the way, so it's still a premium even today. The market is, of course, pricing in the possibility of the deal not going through, so this is why you don't see it at that price yet. For me, Adecoagro remains the largest position in the portfolio, as you can see, and by far my favorite investment ever, and I'm enjoying some very nice dividends. I have an older analysis if you wanna check it out. I just hope they don't ruin it somehow, because finding another good agriculture/food company is actually very tough in this market. Then we had the earnings report from Coolco, the LNG shipping company. It was an overall okay quarter, but because of the environment, they didn't declare a dividend, and the market really didn't like it. By the time I post this, I hope I've already bought more, by the way, if you want to know my opinion. I think these two paragraphs from the CEO sum up this investment very well. We have a currently bad environment because there are too many ships and not enough projects, resulting in very low rates and ultimately profits. But with more projects coming online this year, and I might add a potential push from Trump as he promised, we might see LNG prices fall, which would be very beneficial for the LNG shipping market. And from the company's side, we see what I'd call a very good response. On top of the dividend, they postponed the earliest maturity to late 2029 from early 2027, with the possibility to extend it up to 2031. You know, I'd much rather see them survive and maybe even take advantage of the environment now, as they even mention, than get whatever 5, 8, 10% dividend they would pay at the cost of financial trouble in the future. And don't forget that this company still made quite a ton of money in a bad environment where they even did dry dockings to not lose money in a good one for a 350 million market cap. That, by the way, places them at a price to book ratio of not even 0.5, so I plan on buying a ton of these in the future. I'd say very smart management, and I think we really think alike after this quarter, and a very good, healthy and profitable company in an environment that should very likely improve in the future. Not to mention that LNG is very likely part of our future, and the company can slowly pivot into hydrogen, ammonia or whatever the very long term may be with the money they make from this transition. So definitely a key position for me that I plan to develop. I didn't manage to buy it at the end of February because I was greedy, but it's very likely to come in early March. Another thing that happened is Nokia's CEO retired. He didn't get fired or anything, and it was something he wanted to do for more than a year, I think, but waited to find a replacement first. He's pretty old and did an amazing job, so I can't condemn him. This is something to always keep in mind, by the way. When you see a CEO in their 60s, maybe even 70s, like Barrick's, Intel's or Stellantis', always be aware that you might not see them for that long in that role. In some cases, like Stellantis or Intel or for me Nike, the market may actually like it when they retire. But I like the guy and I really think he saved Nokia and put it on a very good path. He took over in a very difficult time but still managed to get the company near his original target and expected to reach it this year as planned 5 years ago. I think he's really a CEO to remember, and I know him from Fortum, another company that I have, where he also did a good job. Then later in February we saw Stellantis report the full year results, and there we saw a negative cash flow as expected. That's mainly due to the significant inventory reduction that they planned, which affected the operating income and thus the cash flow. Everything was down and we saw the revenue drop by 17%, which, to be honest, given the environment and the reaction we've seen from the market in 2024, is not that bad. They also adjusted some prices, so the margin was and will likely keep being lower. By the way, Tesla shipments dropped by like 45% in Europe in January, while the EV market was up significantly, but I think it's more about political reasons than anything. Musk at this point is an even greater threat for Tesla than before, and Trump's politics are very likely to affect the company a lot. But remember, if you are a shareholder, Elon Musk is not really Tesla anymore. He has a ton of other things he's focusing on, and Tesla was just a big step in his ladder to whatever he plans. Sure, it's a piggy bank for him, but he's no longer at the point of depending so much only on them, which I remember he said some time ago. I really think that if he met the criteria, he would have definitely run for president, but he's not born in America, so this is probably the closest he can be to that, legally. So lower production to support the inventory reductions, but now we have lower prices and the US destocking is complete, so they can now focus on improving the market share and maybe do some cost savings or other improvements. They also announced a roughly 5% dividend, meaning about a 30% payout, so in line with the company's plan. This is the advantage of such a low valuation for still a solid company. So even in such a bad year with significantly lower profits, CEO change, drops in margins and an overall bad environment, they still pay a very solid dividend. It's well above the average, and again, it's only a 30% payout, and they also plan to maybe do some buybacks again in the second half of the year. Now, taking into account the tariffs, they expect everything to improve and even generate a positive cash flow, especially thanks to the second half of this year. So, with a new CEO probably coming this year, having to deal with this environment with potential improvements in Europe, issues in the US, but also potential from China, this should be very interesting. I think the right person can take advantage of the company's brands and solid fundamentals and make this into an even more powerful business. Intel also went up 16% in a single day following some news about a potential acquisition. It is uncertain and there are rumors, but it might be very likely what happens. I'm working on a full stock analysis to take everything into account, so I won't say too much now. I think, however, that this offers a very important lesson. When a company has so many and especially in-demand assets like Intel, it's very likely that there should be some kind of margin of safety. Ignoring the know-how and tech, the company company's fabs and equipment are worth a ton of money, and you could get it for a price to book ratio of even 1 recently. And if you adjust it for the huge investment cycle that resulted in massive cash outflows, the company still makes a ton of money, but more about this in the video. And finally, WBD and MPW, which I talked about in these videos that I think by the time I post this should be out for a couple of days. This is getting pretty long and I don't want to repeat everything that I literally just said, so please watch these videos if you care about either of them. I think both posted very interesting updates, so I dedicated entire videos to each. So now I'd like to say some conclusions and maybe something to learn from this. Sorry for the voice, I'm recovering from the worst flu in my life, but there is too much to talk about. Sure, good contrarian investments bought at a good time when the market really hated them that significantly outperformed the S&P. However, I'd still be very cautious because with the current macro environment, the opposite can also happen in maybe even less than a month. No matter how diversified the portfolio is, we really shouldn't rely on such short-term performance. I didn't sell anything, so other than the dividends, everything is questionable, and until it's a realized profit, meaning when I sell, it doesn't mean much to me. I know some people, especially when we are newer to investing, tend to really care about even daily performance and check the portfolio several times a day, and I also did that long ago when I started. But at the same time, I don't really care about this performance. What I care about, however, are the positive developments for a majority of these businesses. This is what I actually think is very important and can have an impact on the long-term performance. That said, this might indeed be my best month in ages, especially from the perspective of the companies and also as a bonus from the stocks. And I guess another thing is the importance of a catalyst and how the market can react to one, especially when the stock is very low. Celsius actually did another pretty big acquisition the previous quarter and the balance sheet remained very good. It wasn't a brand they can develop, but something they can use to develop the original and now any other brand they might add. It wasn't a huge deal, but the potential to develop two brands at the same time and also giving a signal that more might come in the future really came as a wake-up call for the market, I think. And also, I added some exposure to North and South America, both with very high potential that I really like quite a bit. Again, you can check out the videos I have for pretty much everything that I mentioned. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.